Welcome back. Moving on to exercise 7-6, we'll look at yet another intangible asset, this time goodwill. Before we start reading the exercise, let's go over the definition of goodwill and just talk about what goodwill means. This is typically the largest intangible asset in most companies' balance sheets. It's interesting to note that only when a company buys another company, they will record goodwill. So goodwill is reported by the acquiring company for the amount that the purchase price exceeds the fair market value of the identifiable net assets that they got. So basically, let's kind of quickly go over this once again. When a company does a really good job and creates goodwill as in a customer base, a loyalty base, they have created a name for themselves, someone is willing to buy them for more than what their net assets are worth. That extra that is paid is goodwill. So the company that created the goodwill, they never have it in their books. The one who buys it, they are going to have that in their books. So with that in mind, let's take a look at what we have here. Here we have Mainline Produce Corporation that acquired all the outstanding common stock of Iceberg Lettuce Corporation for $30 million. This was paid in cash. The book value and fair value of Iceberg's assets and liabilities are as follows. Now I have a note here for you. The buyer ignores the book value of the assets and liabilities that are in the books of the seller. So here we have two parties. Mainline Produce that's acquiring, they are buying the common stock of Iceberg Lettuce. So this is in the books of Iceberg Lettuce. We have the book value and fair value. So all these numbers that you see over here, I'm going to strike to this because we are going to ignore it. We do not want it. So anything that's book value, we are going to ignore. What we are concerned with is the fair market value. Okay, so we do not want book value. What we're interested in is the fair market value of the assets. Assets minus liabilities, that's the net assets of the company. Now we can do this in one of two ways. I can either set up my journal entry directly, but I'll first go through this process of explaining what the net assets are and how we come up with this calculation. So let's start with the fair market value of the assets. So I will list all my assets, current asset, property, plant and equipment, and other assets. You list the assets first, and then you say, add them up to come up with the total assets. Total assets is $45 million. Now I got all their assets, but I also assumed all their liabilities. So they have current and long-term liabilities. I've taken on those as well. And those numbers, I bring those over here, and that gives me my total liabilities. Total assets minus total liabilities will give me the net assets of the company. Obviously, I'm looking at the fair market value of the net assets, and that is $25 million. Now, before we get to the next step of calculating goodwill, let's just quickly take a look at this. The current assets, $1.4 million in the books, $14.4 million is a fair value. Property, plant and equipment, $20.2 million. It's $26.2 million. Other assets, $3.4. Fair value is $4.4. So all their assets are worth more if they sold it individually, and if I bought it individually, I'd have paid more. Now, what you will notice with the liabilities typically is they stay the same. $7.8 million current liabilities, fair value is $7.8 million. Long-term liabilities actually could have been a little lower. Okay. So again, we are not concerned with those details over here in this exercise, but I just kind of wanted to go over that with you. Now I have my total assets, total liabilities, and I've calculated the net assets. How much did I pay for this company? I paid $30 million. Their net assets were worth $25 million. So my purchase price, as compared to the fair value of the net assets, I paid $5 million extra. That extra that I paid, that is goodwill. This number is goodwill. This $5 million, this is in the books of the company that made the purchase, Mainline Produce Corporation. So let's do the journal entry in the books of Mainland. Again, this is an acquisition. They've acquired another company. They got all their current assets, so they'll bring the current assets into their books. So they'll list out each of the current assets. Here we're just grouping them and calling them current assets, property, plant, and equipment, and other assets. Now, I also have goodwill listed over here. Or you could skip a line for now if you're just doing the journal entry. I also got their current liabilities and long-term liabilities. And I paid cash. I paid $30 million. I got their current liabilities. We're going with the fair value of the current liabilities. We will list the fair value of the assets. Now, if you take total debits minus total credits, the difference between the two, you will come up with that same number, $5 million. So whether you work through the exercise this way or you just put all of it in the journal entry, this number, goodwill, is a plugged number over here, $5 million. I know how much cash I paid. List all the assets you acquired, all the liabilities you assumed. Those you bring in at fair market value. Those numbers are at fair market value. And then you say we have goodwill of $5 million. Now, unlike other intangible assets, we do not amortize goodwill. Goodwill is subject to something called an annual test, where we test the value of the goodwill and see if it's still good or not. And if it's not, then we get to basically write off the goodwill. So that's an annual test that's done. That's a topic that's dealt with in intermediate accounting, not in this principles class. So with that, we will move on to our next exercise.